Since our last update, the Iran versus US situation has moved into a higher pressure phase where diplomacy is active, but the threat of renewed strikes has returned. The Strait of Hormuz remains the single biggest market trigger. This combination creates a live headline risk for the weekend that could gap markets at the open. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. The Iran-US standoff has entered a stabilized crisis regime. While diplomatic channels are open, the threat of force remains the primary driver of market volatility. Markets are currently being pulled by two conflicting forces. Geopolitics supports oil and gold as safe havens against the risk of regional war. However, the resulting energy inflation is driving US yields higher, creating a massive opportunity cost for gold and weighing on global risk appetite. In this deep dive, we will analyze the 14-point Pakistan mediation, the weekend strike window, and the internal split at the Federal Reserve that is capping gold. First, Pakistan delivered a revised 14-point Iranian proposal to the US side. This mediation by Islamabad has become the primary diplomatic lifeline. On May 18th, Pakistani officials delivered a revised 14-point Iranian proposal to the US side. This document represents the most serious peace effort yet. Point 1 is the immediate release of $7 billion in frozen Iranian assets. These funds have been locked in South Korean banks for years under sanctions. Iran insists this capital is needed for medicine and food imports, while Washington views any release as a potential subsidy for regional proxy activity. Point 2 requires a 12-year halt on all uranium enrichment beyond 3.67%. This is the core US demand for regional security. The US wants to ensure that Iran's breakout time, the time needed to build a weapon, remains at a safe distance for at least a generation. Point 3 involves the total surrender of all 60% enriched uranium. Washington insists this material must be shipped out of Iran immediately. Tehran has offered to blend down the material into lower-grade fuel instead. This technical disagreement remains a major hurdle for the mediators. Point 4 is a guaranteed oil export allowance of 1 million barrels per day. Iran wants this quota to be immune from all future US sanctions. This would provide Iran with the economic stability needed to accept the enrichment freeze. But US hardliners view it as a surrender of leverage. Point 5 establishes a maritime security corridor. It includes third-party monitors to ensure that commercial shipping is never harassed. The corridor is essential for restoring commercial traffic. Currently, daily transits have plunged from over 100 to as few as 2 ships. The remaining points cover a verifiable end to proxy support, a cessation of offensive cyber operations, and a 15-year sunset clause to bridge leadership shifts. Crucially, Point 14 sets up a permanent arbitration panel led by Pakistan and Oman to resolve disputes without resorting to military force in the future. While these 14 points are being debated, the threat of a strike remains live. Trump has paused the assault only to allow for this brief window. Trump described being extremely close to ordering a strike on Iranian coastal defenses. He warned that the military remains in a launch-ready posture. The decision window includes this weekend. If the Pakistani text is rejected, the US could resume strikes within hours of the Monday market open. This is the single most important risk factor for the weekend. A sudden escalation could cause oil and gold to gap up by 10% on Monday. Inside Washington, domestic political pressure is building. The Senate has advanced a war powers measure to limit Trump's unilateral military authority. Congress is attempting to reclaim its right to authorize any sustained military campaign. This creates an internal political barrier for the administration. In the immediate term, oil dropped 3% today. Markets reacted with relief to Trump's comment that the conflict could end very quickly. But analysts warn that this relief may be premature. As long as the choke point at Hormuz remains blocked, the physical supply deficit continues to grow. The world is currently facing the largest oil supply disruption in history. Global inventory buffers are eroding at a rate of 4 million barrels every day. The traffic at Hormuz is a critical stress marker. Daily transits have plunged from a pre-crisis average of 100 ships to between 2 and 16. Nearly 20% of global oil consumption passes through this choke point. The current near-zero flow is structurally unsustainable for the global economy. Ships are being forced to reroute around Africa, adding 4,500 nautical miles to their journeys. This adds massive costs and 15-day delays to every voyage. Gold today is hovering near its lowest level since March. Despite the war risk, the yellow metal is failing to act as a haven in this environment. The reason is simple. The US dollar is at 6-week highs, and bond yields are soaring. High yields increase the opportunity cost of holding gold. The inverse correlation is nearly perfect. As the 10-year Treasury yield nears 4.6%, gold is being sold as a source of liquidity. Now, before we go into oil and gold trade logic, here is what is scheduled and what is not scheduled. The calendar is packed with triggers. 4 hawkish dissenters are pushing to remove the easing bias. They believe the energy-led inflation shock is becoming structural and permanent. The hawks argue that CPI at 3.8% and PPI at 6.0% means the Fed is already behind the curve. They are calling for immediate rate hikes. Markets have already shifted. There is now a 60% probability of a rate hike by January, a total reversal from just a few weeks ago. The weekly US petroleum report, commercial inventories fell by 4.3 million barrels, leaving no room for error. The Strategic Petroleum Reserve has also declined by 8.6 million barrels. The administration is exhausting its tools to dampen the energy shock. Now we move to India. The impact here is practical and severe. The rupee has hit a record low of 96.96 per dollar. Bharat Petroleum's strategy is a case study in crisis management. Due to force majeure declarations in the Gulf, they are forced into the spot market. Refineries are running at 115% capacity, yet they are losing 25 to 30 rupees per litre on diesel sales despite recent retail price hikes. Prime Minister Narendra Modi has issued a patriotic appeal. He is calling for a return to pandemic-era work-from-home practices. India imports nearly 85% of its oil. As the rupee slides toward 100, the cost of those imports ballooned by over 15% in just weeks. The India impact is straightforward. High oil prices keep pressure on the rupee and inflation, keeping foreign institutional flows very cautious. This increases volatility for Indian equities even on days when the index is green. The macro backdrop remains fragile as long as Hormuz is closed. Now, what matters most going into the weekend? Watch if Trump repeats the strike threat or turns toward accepting the revised Pakistani terms. For oil, the short-term bias is sell the rally after today's drop. But remember, weekend headline risk can flip this market instantly. Brent at 108 is the key support zone. 110 remains the immediate resistance area that technical sellers will defend. For gold, the bias is also sell the rally while yields stay firm. Reclaiming the 4,700 pivot is needed to turn bullish. Support at 4,480 is the immediate decision area. A break below that targets the deeper support at 4,350. For India, the key stress marker remains the rupee at record weak levels. The macro backdrop remains fragile as long as oil stays elevated. Let's look closer at the Fed dissent. This isn't just about 1 or 2 members. It's a massive 33% split in the committee's voting power. They want to remove the easing bias, the language that suggests the next move is down. They want to switch the default posture back to data-dependent hikes. The DXY dollar index is also pricing in this hawkishness. A stronger dollar makes gold more expensive for international buyers, further weighing on price. In India, BPCL is navigating a spot market minefield. Buying crude on a daily basis means they are exposed to every single intraday headline gap. Losing 30 rupees per litre on diesel is fundamentally unsustainable. The Indian government is currently subsidizing these losses to avoid a total inflation spiral. The slide in the rupee toward 97 per dollar is a warning sign. Foreign investors are pulling capital out of India to seek the safety of high-yield US treasuries. Modi's austerity plan is a 90-day drive. It's not just a request, it's a structural attempt to lower India's energy intensity during the Hormuz blockade. The deferral of gold purchases is a strategic move. Gold is India's second largest import after oil. Deferring demand for 1 year saves billions in dollars. Maritime insurance premiums have hit 1% of hull value. For a modern tanker, that's a $1 million surcharge per voyage just to enter the Gulf. Beyond the numbers, remember the market psychology. In a crisis like this, fear moves faster than facts. The weekend decision window is designed to exploit uncertainty. Historically, energy choke points have always led to structural shifts in global finance. What we are seeing today is the 1970s oil shock rewritten for the digital age. Our strategy remains the same. Keep your position sizes small. High volatility is the liquidity trap for undisciplined traders. For gold, ignore the war headlines for a moment and watch the 10-year yield. That is the real gravity pulling gold lower right now. Any cool down is a bounce. For oil, watch the daily ship count at Hormuz. If it stays in the single digits, the risk premium will not drain, no matter what Trump says. Flow is reality. As we head into this critical weekend, ensure your alerts are set for Islamabad and Washington. The Pakistani text is the only hope for a Monday open relief. The stakes have never been higher for global energy. For India, the next few weeks will test our energy resilience. Watch the rupee and the retail fuel prices as the ultimate stress markers for the nation. One last recap. Oil at 108 is the decision zone. A break below 100 signals the risk premium is finally being removed. And the rupee at 96.96 is the macro warning sign for India. Stay informed, stay cautious, and manage your risk this weekend. Your best defense is a clear head and a disciplined trade plan. Do not let the headlines dictate your long-term financial health. Control what you can. Knowledge is the ultimate hedge against volatility. By understanding the 14 points and the Fed split, you are already ahead of the emotional crowd. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. We will continue breaking down finance and insurance concepts step by step. If you find this helpful, please like the video. Subscribe to the channel. Turn on notifications so you do not miss future videos. We'll see you in the next update.